What'd you make of Jay Powell's address today? Is he now on Team Mester, Team Let's Taper?
Well, I don't know whether he's on Team Mester or I'm on Team Powell, but I think we see things pretty similarly. I mean, the economy has made a lot of progress. I think that's the great thing about what we did early in the pandemic. And now the question is, is it time to step back from some of that extraordinarily accommodative policy that we put on, and in particular, the asset purchases? And the criteria that we put in the statement about what would it take for us to begin tapering, I think we're pretty much there. Certainly inflation, we made substantial progress since December of 2020. And I think that we've also made substantial progress on the labor market. We're going to get another labor market report before our next FOMC meeting, and I'm going to be very interested in seeing that. The only real risk here is whether the Delta variant is going to cause more of a pullback in demand than I'm expecting. And of course, I'm going to be watching that. But I think basically we've met our criteria. And now it's a question of communicating in an appropriate way so that we can make sure that we're not surprising the markets in some way. And I think the chair did an excellent job today of sort of setting out the thinking of the committee.
Well, should people be thinking that the September 22nd FOMC meeting is a possibility for announcing a taper?
Well, we started out talking about it at a meeting ago. Now we're going to be talking more at the September meeting. My own personal view would be that we want to use that meeting to sort of lay out some of our own thinking about the pace and the timing. And I'd be satisfied if we began tapering sometime this year. And I'm looking to try to end those purchases and complete them by the middle of next year. So I think we're all sort of in that ballpark, and we need to have that meeting in September to sort of codify our own thinking on that. But I think the bottom line is that I think we've met the criteria we put out, or we're very close to it in terms of both the labor market side and have already met the criteria in the inflation side. So, whether it's, September to start in November or November to start in December, I don't think that's going to make a material difference to the economy. I think the important thing and the important message is that we've met the criteria. The economy has momentum. There are certainly risks out there, and, we're going to be carefully watching both the inflation side and the employment side. And as I've said all along, and the committee has said all along, how the economy goes really is dependent on the virus. But, we now have vaccinations, and I think the outcome will be a lot different than it was earlier before the vaccinations were available.
Well, pretty much everybody on the committee has said that they would like to finish tapering before they even talk about tightening. You and others have said, let's get tapering over by the middle of next year. Does that suggest that you have some concerns about inflation and the possibility that you might have to start raising rates sooner?
No, I mean, the way I look at it is we put on the asset purchases. First we put them on because the markets were very disruptive and dysfunctional, and so it was very important for us to go in and purchase those assets. And then we left them on because the economy really needed that kind of very accommodative policy. Now the economy has basically improved enough that we don't really need to have those asset purchases, in my view, supporting the economy. Once we complete the purchases, then the second part of this is, okay, let's think about where the economy is going and calibrating our Fed funds rate. And, we've said the criteria in our statement of what we're going to need to see, and that is maximum employment, and on the inflation side, inflation at 2%, and then, sustainably moving above 2% for some time. So I think we have time, once those asset purchases are completed, to take an assessment of what the incoming data is telling us about the underlying momentum in the economy. And we're still going to be, consistent with our forward guidance. So, interest rates, I think, are longer down the road and not a topic for today, but to come after the assets are completed.
A lot of the analysis on Wall Street is using the term dovish taper for Jay Powell's remarks, because he did talk about still a ways to go and a lot of slack left in the economy. Would you characterize it that way? Are there still concerns that you might have to hold off?
Well, there is still risk out there in terms of the Delta variant and how much that will, affect demand. In my district, it certainly has, a lot of the businesses that business people I talk to, they're concerned about it. They have maybe pushed out the return to the office because of the variant until that subsides a bit in the areas that are covered by the 4th District. But it really hasn't tempered demand so far. So it's a concern. People's attitudes are a little bit cautious, but it hasn't really affected activity. But we need to keep watching for that. In terms of the overall strength of the economy, even if we have some pullback in that, I think the economy will remain strong. That said, we haven't reached maximum employment yet, in my view, and there is still room to go on the employment side in terms of those criteria that we put out for our first liftoff of the funds rate. So again, I think the economy is in good place. I think policy is in a good place right now. And I think we just have to let the economy continue going forward, and then we'll assess that need to raise interest rates as we go. But I think we're in a good path right now. It's just, let's see how the economy performs over the next, several months and into next year before we even think about where the interest rate needs to be.
Equity markets seem to like the announcement today, and the bond market has rallied a little bit. So I'm wondering if you are concerned at this point about asset prices and your contribution to them, and you would be relieved if we start going back down. I noticed you mentioned earlier today that you thought junk bond leverage was quite high.
Well, I'm always, very focused on what's happening in the financial markets, and I think that's appropriate. I think right now policy is really concentrating on what's going on in the macro side of the economy. And so those financial stability issues, I think we always have to pay attention to. I do think that there are some excesses. The real estate prices are frothy. You have the excesses I pointed out in the junk bond market. I think those things are we need to keep a watch for, but I wouldn't be changing monetary policy based on what's happening in the financial markets at this point. It really is an argument about what's happening on the macro side of the economy, and the sense that, we've made substantial progress since December. And so I think it's basically time to really assess the taper, start it sometime this year, and let those asset purchases, taper off and end in the middle of next year. And I think that's where I am in terms of where I view the economy going and the proper policy associated with that outlook.
In terms of the macro outlook for the economy that you mentioned, has yours changed at all? Where do you see inflation, growth, and unemployment now going into 2022?
Yeah. So I have increased my inflation outlook based on the numbers that have been coming in. So, I might have been at 3.5%. Now I'm probably 3.5% to 4% for the year. And that's also reflects the fact that a lot of those supply chain disruptions, if you talk to many businesses across many sectors, they all really said that, we thought that they would turn off earlier and abate earlier than what it's turned out to be. They're lasting a lot longer, and they're expected maybe even to last into 2023, depending on which sector you're in. So those are putting upward pressure on prices. The question is whether that upward pressure is going to raise inflation expectations to levels that are above what we're aiming for, which is 2%. And right now, I still think that inflation will come back down next year. But maybe it's more risk on that inflation outlook than I had before. In terms of labor markets, I think labor markets have improved better than I thought they would at the beginning of the year. And now, I also think that we're going to continue to make progress there, and we'll see better labor markets as more people get vaccinated, as more people can re-engage in economic activity. And I think that's where I see things going in my baseline. There's always risks around there. The Delta variant, we see that in places that don't have vaccination rates that are high, we see Delta creating real problems for people. And so, we have to still take be humble about our ability to forecast the virus, because the economy does depend on how the virus plays out. My own view is that we've learned to navigate the virus. We have a tool now, the vaccination, that can really, really help us get through it. And I'm hoping that more places will have vaccination rates that move up, and so that we can sort of continue to engage with the economy. But we'll have to see. And I think policy is positioned to be able to take the time to look at that.